So we're going to start with open questions on the realities of startups, which I always find fun to teach because it's basically my book on the realities of funding for entrepreneurs with the word them and you switched.
So in part two, you talked about what startups need funding for.
Yep.
And I was curious if there's something that stands out as being a really good opportunity or a bad opportunity, depending on what they need money for, like marketing versus operations or something like that.
No, it's totally dependent on how much you believe they've accomplished, how much you believe they will accomplish with the money they're asking for. There's no bad use. Well, yes, there's no bad ask. There is more efficient needs of money or more urgent needs of money than others. What you really find a few different models out there. The prevalent one that you'll see in angel groups is the California model of investing, which is let's go burn a whole bunch of money to grab some market share, not to prove out the market, but to create the market and go grab the market and go buy the market. And then we worry about profits later in that model. That's the one you read about in the paper all the time. That's what the tech companies do. But in the rest of the world, in the 95% of companies or 98% of companies, there's all sorts of needs of capital. And it could be the corner bakery needs a bigger oven or needs a delivery truck or needs, in Africa needs some power on the roof.
I had a quick question. Talk to me about what you mean by earnings or earned money. Is that revenues? Is that profits? What is it?
Yeah, the typical lingo is earn or burn. So the California capitalism model is burning capital. You take investor capital and you spend it in order to grow your company. That's the burn model. And the earn model is you find customers who pay you for your product or service. So that's revenues.
Just revenues.
Yeah. So I know the word earnings is used in the public equity space to mean profits. And the word earnings is also used in general in business to mean revenues. And it's unclear at any given moment what you're usually talking about. My work is almost exclusively focused on revenues. I rarely ever talk about profits with my companies. I ask them, were you profitable last year? And when they say yes, that's the last I asked of them. I might ask what your profit margin is, but I don't dwell on that. I dwell on the KPI that I dwell on most is top line revenues, because everything else gets messed up in accounting. We'll get around to financial models and financial reporting. It takes a lot more effort to figure out that line that they're calling net, net what's included, what's not included, how many net lines you're going to have. I like to just focus on that top line number because it's nice and clean and simple.
But
and more customers is good.
Doesn't revenues have a completely different meaning based on margins? Because if I have a grocery store that has a 5% margin on canned peas and generates $100,000 worth of income, or a software company who has an 80% margin and generates $100,000 worth of revenue earnings, those are completely different companies in terms of what I think I would want to invest in.
Yes, absolutely. When you're doing the due diligence stage of the investment, yes, you want to understand how the revenues from customers turns into profits eventually, and where the margins are and where they disappear to. And if you have two companies in front of you and you're trying to decide which one you want to invest in, and the only two differences are one's high margin, one's low margin, that will make a difference to you. But in general, what I'll tell you is that if you're running a portfolio of companies, which ideally as an angel, you have 15, 20 of these investments, you're going to want a mix of those things. And in all cases, 100% of the cases, if they tell you revenues went up, you will be happy. That's really why I dwell on revenues. I want their revenues to go up. They want their revenues to go up. We can agree on revenues going up is a good thing, and we can talk about that. And we have no conflicts when we talk about that. And every once in a while, we dive into some other ratio like gross margins or net margins, or what are you spending per dollar of revenue on salaries? That's a ratio. I don't even know if it has a name. but it's a ratio that I'll pull up every once in a while, and I'll just look at how's that doing over time. Is that going up or down? Right. And so if you, again, high margin or low margin, over time as the companies grow, you expect scaling to have some benefits, which means costs should go down per dollar of revenue.
So Noni, your financial models are focused on revenue. It's revenue based. Is this the reason why you don't worry about profit?
I don't worry about profit because I have no control over it as an investor. So when we get around to the talk on revenue-based investing, we'll go a little deeper in this because it always pops up. As an investor, I have some control because, again, when we talk about what people spend their money on, right, it's inputs or market share or marketing or equipment or whatnot. I can have a nice, simple conversation with an entrepreneur saying, okay, what do you need to increase your revenues? And they can say, well, I'm at max capacity with the equipment I have. I need these 2 pieces of equipment. And I can say, great. How much will that cost? And how much more will revenues grow? And what I'll look for in terms of ratios is, will revenues grow more than what we're putting in terms of machines? So if you think of a US factory, right? When a US manufacturer says, I'm going to create a new factory, they say, I'm going to spend $1 billion creating a new factory, or $10 billion creating a new factory, doesn't matter. They don't say it's going to increase revenues next year by $1 billion. That doesn't happen. That scale of growth doesn't happen in the US. But it does happen overseas where I do a whole lot of investing. So if they say I need a $100,000 piece of equipment, it's going to earn revenues, it's going to earn the company, $300,000 more next year, or $500,000 more next year. That looks interesting to me. And so I will dwell over there in that world of revenue and revenue growth because I have some control over it. And then that's the part where we'll say, well, okay, let's look at what your profits were last year. And it gets really tricky. 2 things get in the way. One, the people who are entrepreneurs are generally not the same kind of people who are finance experts. If you looked at all of the CEOs, we just took the venture capital world and we took all the CEOs and we said, what was your last job? Very, very few of them will be CFO or controller or accountant. And if we said, what did you study in college? There might be business degrees, some of them, but there aren't going to be very many finance people who are CEOs. It's just not, the people who do numbers are generally not the people who are the visionaries to start companies. And so they're really bad at accounting. One of the things is it's really hard to know when you're looking at financial statements. We know that that the bank account went up last year, but trying to tease apart each line in their statement, trying to say, okay, was this an investment you made for this year? Was it an investment that has a lasting value over multiple years? Was this really misinterpreted and put in the wrong part of the financial statement, and therefore affected what that line is that we call profits? That gets to be really hard. So I don't dwell there. I leave it to the founders and the management team. They want a lasting company. They have to figure out how to make profits. That's their job. My job is to provide them the capital to keep growing, and I have to just trust that they can do a decent job to keep the bank account growing. And when it doesn't, when it's empty, as an investor, I hear about it. I don't have to manage it. I get an email saying, we need more money. We're low on money. We need money for something. They'll give me some reason why. And 2 minutes into the conversation, the answer is, well, you're not running profitably. So how do we fix that? Before we give you the next chunk of money, how are you going to be profitable? And then I'll get the story answer. I usually won't get the number answer. It's not as easy as doing, being on the CFO call with the public companies with the professional CFO around. Most startups just don't have that. Even VC funded startups will get something like that when they get that VC round after angels, years after the angels have invested. And that'll be a part. At my companies, they were always part-time CFOs. So we would hire a 1/4 CFO after we got Series A investments. Before that, we had an accountant do the books, but they were just keeping track of things for the CFO to handle later. They weren't actually good financial statements. No audits or anything like that. I'll take one more and then we're going to keep going because we have a lot to do today.
Mooney, I was curious with just some of the stats on like 50,000 angel investors in a year or whatever. It kind of made me have similar emotional response to like all of the failed startups from some of the previous slides. Is there any corollary between how many of those 50,000 angel investors succeed or don't succeed in relation to how many startups fail? Like,
Are you going down the right path? I think the number's bigger because we had the ACA come on in one of the free webinars, and she said the number's more like 200,000 angels. So we track angel investing pretty good in this country, but we don't track it good enough to know exactly how many deals were done. So let's say somewhere between 50,000 and 200,000 people wrote angel checks in the last, call it 2 years, because 2020 was an anomalous year. How many that make money? We have no idea. But what we do know is there was a study done by Rob Wiltbank at back when he was at Willamette University in Oregon. He found a data set of 6,000 angel investments. He's a statistician, and he checked 3 ways to Sunday that this was an actual useful real data set, not just a set of winners. And then he looked at it and said, okay, what numbers come out of this in aggregate? If you invested in all 6,000 deals, what would your return be? And the answer was 2.6 times your money back. And then a whole bunch of other analysis. I can include the link in my follow-up email this week. But a bunch of other analysis like, okay, well, how many of those were 10x or better, and how many were 5x or better, and how many were losses and whatnot. And so he proved that if you invest in enough of them, yes, you can make money. You'll make exactly the same returns as a venture capital fund. If you invested in any one of them, your odds of getting your money back is low. Someone else took the data set, a group called Right Side Capital in California. They took the same data set. They got permission from Rob. And they ran another analysis on it that said, what if we go and do large numbers of investments? What if we do 100 investments per year? Then what? What happens? What if we do 200 investments per year? So this is not something an angel would do, but this is something that a bunch of angels might do together as a group. And the answer was, if you do 100 investments, your odds of getting your money back are like 98%, something really, really high. And if you do 200 investments in a portfolio, it doesn't have to be in a year, but if you have a 200 investment portfolio, it's like 95% chance you're going to double your money, right? With a decent chance you're going to get to somewhere closer to 3x. And so these are tech investments. This is not my style of investing in revenues. This is just straight up hunting for unicorns. What's the result going to be? Yeah, you do enough investments, and everybody says, Rob will tell you, it's 15 or 20 is sufficient. You do 15 or 20 investments, you have decent odds that you'll not lose money, and you might actually beat the S&P 500.
That's encouraging.
If I didn't think it was useful, A, I wouldn't do it, and B, I wouldn't advocate other people do it.